Hello, welcome to the EfTEN United Property Fund webinar. My name is Kristjan Tamla and I'm head of retail at EfTEN Capital, and I have the honor today to guide you through this short presentation about the EfTEN United Property Fund. During the presentation, you all have a chance to ask questions. There is the Q&A dialog box in the webinar application. Please type your question there, and I'll try to address this question towards the end of the presentation. And if it turns out that I'm not skillful enough to find out that there are questions, so that you have asked the question, but I somehow ignore it, then please just send it over to me by the email, and then we can sort it out later one-on-one. Because I honestly admit that I do not have too extensive experience in working with this webinar application, but let's see. Let's hope it works out well. I'll touch upon 4 main topics today during the presentation. First of all, I'll give you some international background, what has happened in the real estate sector in Europe, what has happened in financial markets in Europe. And this should also give you an understanding that why in EfTEN we have been so cautious, I would say since already last summer, in deploying new capital, why in the EfTEN United Property Fund we still have roughly 1/3 of the capital as uninvested, and why we haven't really rushed into deals. Then I'll briefly go through the main events for the EfTEN United Property Fund last year. The biggest part of the presentation, I will elaborate on the existing portfolio, how it works, what are the yields, going through the main properties one by one. And last but not least, I will then finish up with outlook, that how we see this year is evolving, and how we plan to run the fund in this environment. Let me now try to change the slides. All right. Starting with international background in real estate sector and in financial markets. If one looks back 1 year ago and compares the current situation to, let's say, the start of 2022, then in my opinion, by far the biggest change in financial markets has been the increase in interest rates. For almost a decade, we were in a situation where money had basically no price, where central banks kept interest rates at 0, or in some cases even below it. And as a result, companies, also governments, also households had a chance to borrow at almost non-existing yields. And what it meant that sort of if the return expectation on the borrowing is close to 0, then it also means that the return expectations of different assets start to come down. And this applied also to real estate, where a lot of leverage is used. And on the left-hand chart, you can see that it was very common in Europe, in European main capitals, in main business districts, to make real estate deals with the yields which were for a number of years around 4%, in some cases even around 3%. The office buildings in main business districts in Milan, Paris, Frankfurt, Madrid, they changed really hands, so that rental yield was less than 3.5% in a number of times. So what happened when now the central bank started to increase interest rates is that it's like a gravity of law in the real estate market, that if interest rates change, then it also has immediate impact on the real estate, since we use a lot of leverage. And what happened is that today, for a lot of those property deals which were done at 4% or even at lower rental yield levels, the financing cost is now above it. The financing cost is now well above 5% for those property deals. That's the red line on the left-hand chart. And now those property deals, when they need to refinance their debt, they are running sort of more and more into troubles, meaning that sort of if they want to refinance, then their refinancing cost is already above 5%, but their sort of rental yield, what they get is still around 3.5–4%. And we are pretty sure that the number of properties which will face such kind of refinancing issues this year, but maybe also next year, the number will increase sort of month by month, and we are going to see a number of deals coming also to the market where the existing owners can just not refinance anymore, and then they just need to sell them. And if we look what the financial markets are pricing in, then the financial markets are actually pricing in pretty doom scenario for the European real estate sector, especially for those who have a lot of leverage. This is the chart which shows at which price to book level the European real estate stocks and also real estate funds which they are trading at. And as you can see, they are trading at the 40% discount to their price to book value. It's basically the same discount what it used to be during the financial crisis in 2008–2009. This means that financial markets are actually expecting that a lot of European real estate companies, real estate funds, they are either cutting back their dividends, or in worst case scenarios, they are also forced to dispose some of their assets, and then probably at fairly low prices, as it will be forced selling. In the Baltics, the situation in this respect is not as bad, and why it's so is that in the Baltics, in the property market, in the commercial property market, we do not use that much leverage as it's the norm in so to say developed European countries. Here, generally, sort of the leverage levels for property deals are around 50% of the value of the property, whereas in Europe, 70%, in some cases even 80% leverage is quite common. So as a result that we use much less leverage here, I do not see that the increase in interest rates is going to have a systematic problem to the real estate sector in the Baltic countries. However, still, according to our calculations, more than 200 million euros of debt needs to be refinanced by different property funds in the Baltic countries. And it is highly probable that some of those refinancing deals will not be very successful, and then some properties will come also on the market where the sellers are in a forced position to sell. And as a result, we will see that gradually, when the refinancing deals will approach, more and more properties will be put also on a sale at a more favorable or at a more lower price, what we have seen recently. The other thing, what in our opinion will have an impact on commercial property prices in the Baltic countries is the change in the risk-free rate. A lot of international and institutional investors, when they value different investments, they use a risk-free rate, which is often proxied by 10-year government bond. They use it as a basis. So if the government bond yield is X, then making some sort of a risky investment, they want to have a return X plus something. And if we look what has happened to this risk-free rate in the Baltics over the past 12 months, then a year ago it was 1%, today it's roughly 4%, meaning that this sort of basis where a lot of institutional investors calculate what sort of return they want from different investors, this basis has increased from 1 to 4. And if the risk-free rate is today 4%, then I'm pretty sure that also the commercial property deals, which were done a few years ago in the Baltics at the rates of low 5% rental yield, they are now a history. And sort of this increase in risk-free rates will also translate into the property prices, and property yields in different transactions need to go up as well. So to sum up the first part of the presentation, different property and real estate companies are facing trouble in Europe due to the increased cost of leverage and forced selling of assets is definitely expected there. We do not see that the increase in leverage cost will be of a systematic issue in the Baltics, but definitely there will be deals which will have troubles in refinancing the existing debts, and as a result, we believe that more and more properties will come into market with also more favorable prices to buy. And also this is sort of further confirmed by the fact that since the risk-free rates are today so much higher what they used to be a year ago, then this should, at least to some extent, translate also into the prices of more risky assets, including real estate. Now coming to the second part of the presentation, which is the sort of main events for the EfTEN United Property Fund last year. 2022 was the first full year for the fund. Altogether, we raised almost 10 million euros new capital. And just before listing the fund on the Nasdaq Stock Exchange at the end of May, we had the IPO, which was strongly oversubscribed. And we actually had an option to raise even more capital during this IPO. But since we saw that the market is changing, real estate market is changing, and it will probably take longer time than usual to deploy the capital, we decided that we are not loading up the fund with a lot of fresh capital, and so that it will stay there for long time without really putting it properly to work. So as a result, we raised 10 million euros of capital last year. We made 2 distributions, altogether roughly 3.5% of the market cap for the fund. The second distribution factually was done in January this year, but we announced it already late last year. So considering that the fund, it was the first full year for the fund, and it generally takes time for real estate investments to start to effectively work, and furthermore, 1/3 of the fund is still uninvested. I believe that sort of almost 3.5% distribution level is quite good result in an environment where interest rates are increasing and real estate is generally under pressure. We made 2 new investments. In February last year, we bought the first direct cash flow investment to the fund. It's the B-class office building in Vilnius, and I will elaborate a bit on that later when I talk about our biggest investments. And then 2 times we invested into EfTEN Kinnisvara Fund, which is the first real estate fund managed by EfTEN Capital. We bought the shares of the fund in April, and in November we bought the shares already at 10% discount. And I think that this sort of 10% discount is also a reflection where we think the sort of B-class rental yields in the Baltics should be, because the fund itself is valued roughly at 7.4% rental yield, and if one takes a 10% discount, then we get 8+% entrance yield, how we entered into this transaction. And this is pretty much the level what we see, which is sort of adequate today to do deals with the B-class portfolio in the Baltics. So moving now to the third part, and then which is the main part of the presentation. That's the portfolio for the EfTEN United Property Fund. The portfolio consists of 30 underlying properties, either directly or through different EfTEN funds. 60% of the portfolio is invested in cash flow properties, 11% is in one development project, and roughly 30% is uninvested. The weighted average rental yield of the cash flow projects is today at 7%, and it's well above the cost of the leverage what we have for the fund, which is 4.1%. So the chart what I showed you earlier about the situation in European property market, where for a lot of properties the cost of leverage is already higher than the rental yield, this is definitely not an issue for us. We have still a very hefty buffer that our rental yield covers the cost of leverage very easily. The vacancy rate of the portfolio is surprisingly low. Roughly a year ago, we were slightly afraid that sort of the increase in electricity prices, increase in gas prices will also put more tenants under pressure, but the tenant behavior and payment behavior has been surprisingly good, and the vacancy rate stands at a very low of 1.99% for the portfolio. When talking about the main investments, I'll start with the biggest investment, which is Danske office building in Vilnius, and we own it through the EfTEN Real Estate Fund number 5. It makes up roughly 20%, slightly less than 20% of the portfolio. It's an A-class office building in Vilnius with a total size of slightly less than 10,000 square meters. The business case, or let's put it this way, that we always have in mind some sort of a business case when we purchase a property. We just do not purchase a property sort of without having an idea how we think we can either improve it or how we think sort of it will earn for our investors a bit better yield than most other investors potentially see it. The business case here was that this A-class central business district situated property was fully leased out to Danske Bank back office jobs. And back office jobs generally are fairly low value adding jobs, meaning that in addition to low salary levels, what can be paid in those jobs, it's also that the rental yield or basically the rental rate, what can be paid when those jobs are renting out premises is fairly low, because sort of in the back office jobs there is only one key criteria, and it is the cost. The lower you can keep the cost, the more efficient you are. And we had a business case that this sort of A-class, very well located office building, there we can actually change the tenant mix. We can change the Danske Bank back office and sort of rent it out to more higher value added services sectors. And to be honest, we have been extremely successful with that one. As of before yesterday, I got very positive news that the last part of the building was now leased out, and the vacancy of the building is now 0%. It has now 12 different tenants as compared to one tenant in case of Danske Bank. And we managed to increase the rental level from 15 euros per square meter in a month to almost 17.5 euro per square meter. So basically, in 1 year, we managed to increase the rental income of the fund by almost 20%. By just reshuffling the tenant mix, and that was our business case, and it really worked out. I asked our Lithuanian colleagues that what do they think, how much they can index the rents this year, because sort of indexation of the rents is now a very, very hot issue. Partly because of the increase in interest rates, but partly also how much the tenants can afford due to increasing electricity prices and other communal prices. And I got an answer that since most of the rental contracts are fairly new, then they are expecting that the potential indexation will be in the range of 7.5% this year. So not the full sort of double-digit indexation what some are expecting due to high interest rates, but still a very nice 7.5% increase in rental income currently our Lithuanian colleagues are expecting for this property. And also to give you some background, then our financial department did a very, very hefty and really quite difficult exercise in calculating that how much sort of the increase in interest rates, how much we need to raise the rental level to compensate the increase in interest rates. And basically the rule of thumb for our different funds on average is that if the interest rates increase by 1 percentage point or 100 basis points, this means that we need to increase the rental income to compensate it by 5%. So sort of with a 7.5% rental income expected increase for the Danske office building, it is roughly balancing out interest rate increase of 1.5%. The second building or the second investment, our Menulio office building in Vilnius, which is slightly smaller and makes up 14% of the fund investments. It's the B-class office building in Vilnius. And it's the left-hand building on the picture. The right-hand building is actually in the EfTEN, in one other EfTEN fund. The business case why we entered into this building was that all the rents for 20 different tenants. There are 20 different tenants, and all those rental agreements, all the rents are indexed by the Lithuanian Consumer Price Index. And early last year, we started to see that inflation is gradually picking up. Of course, it was hard to see that it's picking up to 20% where it did, but sort of we had a business case that in this property, all the rental contracts are indexed by the Lithuanian CPI, and it gives us a good opportunity to also increase the rental income through indexation in the next few years. And also I talked to our Lithuanian colleagues, and they are expecting that sort of they can index in this property this year more than 10% the rental income. So the rental income in this property will be more than 10% higher this year, which sort of by this rule of thumb what we have in our funds corresponds to more than 2% interest rate increase for the cost of leverage. So we are actually compensating with this indexation more than 2% increase in the cost of leverage. The last or the third investment, what I will slightly elaborate upon is our Uus-Järveküla residential development in the Rae parish. It's just next to Tallinn. And we are actually financing the development of altogether 165 terraced and detached houses. The business case is that it's an affordable family-oriented living just next to Tallinn. If we look at this sort of population structure in Estonia, then by far the biggest part of people are concentrated to the age brackets from 30 to 40. These are people which were born in late 80s, and they are in the stage where they have already one or more children, and they want to move out from their small 1 or 2 bedroom apartments. And our business case is that we should be able to offer those terraced houses at a lower price than 4-bedroom apartment buildings, new apartment buildings in Tallinn. And to be honest, we have had really strong demand for them. Out of 165, we have put on sale only 62, and 54 of them have been booked so far. December was a very quiet month, sort of almost no or very few real estate transactions were done. In Estonia, people were slightly afraid that the real estate market would turn strongly down. But now, starting from mid of January, we are seeing again the interest also towards our development project. And the last information from the salespeople of this project, what I have, is that actually on a daily basis, potential clients come and want to talk about potentially buying into this property. The property itself is now in the phase where we have the construction permit to build the infrastructure, and we are actually expecting also a construction permit to start to build the first houses in a very near term. And then sort of maybe to finish off with this part of the presentation, I will also slightly describe what is happening in our investment at EfTEN Residential Fund. Although it makes up only 3% of the fund, quite a lot of things is happening there currently. There is today one project which is fully operational. It's the rental apartments in Kadaka, altogether 113 apartments in Tallinn Kadaka, and today it's fully leased out without any vacancies. The other rental house what we are constructing in Kaunas should be finished now very soon. We already had the first pictures of fully finished apartments, and I know that first rental contracts have already been signed, and it is expected that this house will be sort of starting to be leased out in April, and so the sort of cash flow from EfTEN Residential Fund should also then increase as instead of one property there will be then 2 rental houses which will be rented out. There are 2 more constructions going on in this EfTEN Residential Fund. One is the biggest apartment building what we are currently sort of building for renting out in Vilnius. It's altogether 145 apartments, and we expect the construction to finish in spring next year, and then also this one will be rented out. And the last one is in Riga, where we are expecting to develop 110 plus 111, 112 apartments, and we will only start with this construction later this year. So quite a lot of construction taking place in this fund, but also gradually more buildings then also coming to the market and will be leased out. So with that one, I have finished also my third part of the presentation. Here you can see sort of how the portfolio is distributed between the different properties. Starting from the property number 13, the weighting of this property is already below 1%, and I didn't list those 18 properties which have a share in a portfolio less than 1% here, but you can look and familiarize with all of them on our website. So the outlook for the fund. First of all, the distribution. We made the first distribution this year in January, and the next distribution will likely come somewhere towards summer, and it will come from the investments to EfTEN Kinnisvara Fund, EfTEN Kinnisvara Fund 2, and Minulio 7 office building. And the numbers are not finalized yet, but sort of according to the preliminary calculations, the next distribution will probably be in the range of 2% of the market cap for the fund. And if we add the 2.5% distribution earlier in January, then it will take this year's distributions closer to 4.55%, which in the environment where 30% of the fund is still uninvested, I think is quite nice cash flow back to the investors. On planned investments, we are gradually now seeing, after many months, after more than half a year, that first properties are coming to the market, and are coming to the market with the price what we are already interested in to look at. I must say that sort of the very recent offers what we have had are mainly the B-class office buildings in Vilnius, where the fund has already fairly big exposure, and sort of we do not really want to increase this exposure currently, or if we want to do it, then we want to do it at a very good price. So we are actually now looking at sort of also more properties in other segments will come to the market where we would be interested to invest in them. It will probably take a few months, is currently my wild guess, until most of the fund will be invested. So probably in sort of March, and definitely first half of April, or maybe the full April, we will still see that sort of fairly large part of the fund is uninvested, but we are now seeing quite promising developments in the property sector, that more and more properties are being offered at already lower price, and at the price which is more interesting for us as well. Regarding the capital raise, I'd say that sort of our first priority is to put the current uninvested capital into work, and to put it into work so that the investors have a better understanding how the fully invested fund will perform, what will be the distribution rate of the fully invested fund, what will be the NAV change of the fully invested fund. So sort of we are definitely not focusing on the capital raise this year. We are really focusing on sort of investing the existing free capital in a favorable terms, and as a result, I expect that we will not raise any new capital for the EfTEN United Property Fund this year, or at least I think it's fairly unlikely. And last but not least, I think sort of I'm obliged to comment also a bit on a buyback program, what was in our intention to include into the fund terms. We sort of, our understanding is that buyback program for the property fund is definitely not something which is sort of main part of the investment activity or which is sort of really main part of our investment policy. Instead, we see it as an option when, for example, sort of the listed market where the fund is trading, the stock exchange, when this has really overreacted to the actual real estate market. For example, at the situation when the sort of market price at the Nasdaq stock exchange for EfTEN United Property Fund is well below to the level at which one can make real property transactions in the market, then potentially this sort of buyback program would be something to use, because then we can actually buy indirectly our own properties at a cheaper price when sort of as compared to the real market transactions in the real estate market. But definitely it is something which could be used only at very extreme situations, and definitely would not affect our daily management. So we included this or we wanted to include this option to our fund terms, but to our I would say a big surprise, the FSA did not approve this change and reasoned that the buyback program is only allowed for companies and funds which have equities or which have shares but not fund units, and sort of that the European regulation covers only sort of that kind of structures which have issued shares. To be honest, I admit that it was a big surprise, because the market practice in Estonia in this matter is different. There are funds which have units and which have used buyback programs for their fund units. So I'd say that sort of we are now expecting some further clarity regarding the market practice in Estonia as well, that how the FSA then sees what is the relationship of the buyback program and investment funds which do not have shares but which have units. And I hope that we'll get this clarity during this year. And I guess with that one I am finished with the presentation what I plan to give you. And let me now please share whether there have been some questions asked. I do not see questions. It's either that there are no questions, or it can also be that I'm not skilled enough to see them. And if it's the second thing, then those who did ask questions, but I can't see them, then please just email me directly. You can find my email on the EfTEN Capital webpage, and just email me, and I'm more than happy to address them one by one. So thank you all for those who joined the webinar live, and thank you also those who will later listen to the recording, and goodbye from my side.